today's topic is learning loans with Reed, and he's going to be covering the 2-1 buy down, adjustable rate mortgages, and he's going to be covering basically, a lot of buyer objections that we're seeing out there in the marketplace. And, we've known Reed for a long time. One of the reasons that I look to Reed for advice, number one, he closes pretty much more loans than anyone else, like nationwide. So he's Scotsman Guide rated as one of the top lenders in all of the country. He is an investor. He owns his own investment homes. He owns rental properties. He is, a very communicative, very good lender. He's been a great partner to us. And he's one of the things he does really well is he keeps the buyers engaged. There's been a lot of times where we've had buyers that got a little panicky, and Reed has that kind of experience and that perspective to keep people engaged in the deal. So I don't take advice from anyone. I like to take advice from people that I admire and look up to, and Reed is one of those guys. So super grateful to have you on the call, Reed, and just wanted to give you a quick little bio. So we know this is not, this isn't your first day in the business. This is something that you've really accomplished. You've been very successful in, and you have a great perspective in that.
Thank you. I'm so happy to be here, and thank you for having me. And Samira, just great seeing your guys' company grow. I'm just so excited that this is all growing the way it is, and just to be a part of it. So very, very excited about that. I think today, obviously, as the market has become more difficult, we need more options. We need more comebacks. We need more comebacks right now than ever. And also, we need more personal confidence. I think that helps us to sell better, right? So we want to feel positive about what we're selling. We don't want to feel like when someone calls us that we need to tell them it's the wrong time to buy. I don't want to do that. I know Kurosh had been here with me doing some training, and I told him if rates went to a certain level, it was going to become a little bit more, I was feeling like it was going to become harder to sell and harder to feel as into wanting to sell this market. So overcoming objections, I sat down with a couple of my other partners too, and just talked about it, and how are we overcoming objections in this market? And through doing that, through going through an hour and a half or so of doing that, I realized that there is still so many reasons to sell in this market and to sell through any market. So, and there's always advantages to owning real estate. So, tons of opportunity actually in markets like this. So when we get to the end of the presentation too, I'd love to go over some of the overcoming objections that I'm seeing for buyers and sellers. To start into some of the options that we have available. So 30-year fixed mortgages have always been the safest bet. People feel the most confident in 30-year fixed. They something about knowing that your payment's not going to change on you later. I think in 2006, 7, 8, 9, and 10, where there were a lot of those minimum, NAGAM option loans, you're only paying a portion of your interest. You're not even paying your principal and interest. You're just paying a portion of your interest. And when those loans reset, you had to pay your fully amortized payment, where you're paying all your interest and a portion of the principal that you owe. Those payments were too high. People couldn't afford them, and they lost their homes. And I think from that time, it's engraved in people that they want to have a fixed payment. They want to know what their payment's going to be. Now, your property taxes in California adjust over time, right? They can go up or down by 2% a year. So you're going to get a little bit of rise in payment over time there. I noticed this year, all of my insurance policies on my properties all went up a lot, which was nuts. I haven't had that happen in a long time. And they went up a lot, like 20% across the board. So you're going to have increases in payment, but the principal and interest payment not going up is something people are very comfortable with. So what other options do we have, right? You have 30 that may have a lower payment to start. That's really important right now. Right now is a great time to get an opportunity to get a good buy. Maybe you can have options again. You guys know this. I mean, Stephen, when you go out and you go home shopping, there's actually a couple more homes on the list you can go and you can see, which is great. Maybe you can get some good seller incentives. Maybe you even get a lower price than you did last month, right? So it's a good time to get out there and do that. But when the people see the payment, I feel like it's shocking to them. And I do a lot of pre-approvals first before they go shop, but a lot of people go shop too before they get pre-approved. It just happens, or they start looking and then when they get the payments, it's a little hard to overcome that. So what are a few programs that are going to start shining as 30-year rates stay this high? Because they might not go up too much more from here. Maybe they will, but they're probably not going to go down dramatically anytime soon for 30-year loans. Even if they went down 0.5%, it's not going to be shockingly low where we're going to change, right? It can go down a full percent from here. It's still going to be high 30-year rates. And the flip side is, what if they go up 2 or 3% from here, right? The 30-year product still will have meaning if you're buying an investment property, putting a big amount down. Maybe you want to go 30-year fixed just to be ultra conservative. But I think if rates go up another few percent, I do believe that the loans I'm going to talk about today are going to be a lot more prevalent. Now, before we get into the types of loans, I want to cover the main types of loans. 30-year fixed, principal and interest, where you're paying back what you owe over a 30-year period. The loan is amortized, meaning the payoff period is over 30 years. You then have short-term fixed loans, 3-year fixed, but the payment's based on a 30-year amortized loan. So the payment's not going to be much lower just because it's 3-year, but the rate will be lower. So for that first 3 years, the rate will be lower, and that will give you a lower monthly payment. I'm going to talk about how they adjust in a minute. 5-year fixed loans, rate's a little higher than the 3-year. It's called a 5-year adjustable rate mortgage, 5-year ARM. 7-year fixed. The 5 and the 7 are pretty close to each other. So the 7-year is a little bit more of a frugal option if you still want a lower rate than a 30-year fixed. Then you've got 10-year ARMs, 10-year fixed, and then 30-year fixed. The 10-year and the 30-year are pretty close to each other, so most people will not do a 10-year if they're going to do an adjustable rate mortgage. They'll do a 5-year or a 7-year. So other loans I want to talk about today are 2-1 buy down and how that works. Basically, you pay some costs up front to start off with a lower interest rate from a payment standpoint, and it adjusts every year for the first few years. And I've got some cool stuff on that. The last program is the all-in-one loan. The all-in-one loan is a home equity line, and it's a first lien position home equity line. Normally, people get an equity line on top of their current loan. So they have a 30-year fixed loan, and they want to get a second loan out. We've all heard of doing a second or a home equity line. They get a line of credit, just like a credit card. It's attached to their property. It's got a whatever, $60,000 balance. They can use it like a credit card. When they use it, they're going to pay interest on what's on the credit card. When they pay it off, they're not going to pay interest on it anymore, right? So equity lines can be really cool for being able to access cash. It's the only type of borrowed funds that you can use to purchase an investment property or a primary residence, or a cash out refinance. So if you were like, someone says, I want to go get a personal loan or a credit card to buy a property, that's not equity from an investment property. It's not able to be used to buy a property. You have to use it from a home equity line of credit. So the all-in-one loan is a first lien position equity line. There's no first loan. It is the first loan. And it allows you to operate like a bank. It ties the equity line to your checking account, and whatever your balance is in your checking account throughout the month, it will go against whatever you owe on your all-in-one. Quick example, if you had $100,000 in your checking account and you have $1 million all-in-one loan where there's $1 million of loan on that line amount, for every day in the month that $100,000 is in your checking account, you're only paying interest on a $900,000 loan amount. Okay, so this allows you to operate like a bank. So the all-in-one, we could do a whole presentation on it. I'm not going to go that much further into it yet. But with the interest rates before on all-in-one loans versus 30-year fixed, it was almost impossible to sell the all-in-one. People are getting 3 or 2.5 or 3.5 or even 4, and they look at it all-in-one loan that has a 6% interest rate, and they would shy away from it even though it has so many benefits. Now with rates being so high, the all-in-one loan is a phenomenal product. So it's something I'll touch on a little bit later. Okay, so let's talk first about the temporary buy down product. Let me know if you guys can see. Can you guys see my screen?
No.
No, I don't see anything.
Hold on one sec.
I don't think so.
There we go.
It looks like it's starting. There you go.
You guys see now?
Yeah.
Yep, you're
You
good.
guys see that?
Yeah.
Thumbs up? Okay.
Yep.
Okay. Okay, so before I dive into the explanation, actually, let's look at an example that I put together. Just my There's an Excel sheet that I use for it. Okay. So the temporary buy down loan, how does this work? First of all, what type of a loan is it? It's a 30-year fixed, 30-year amortized loan. So this is not available for ARM products. It's a 30-year fixed loan. What are the benefits? So let's look on the left-hand side up here on my screen, okay? The loan term, or let's use a 715 loan amount, okay? 30-year fixed loan, so it's amortized over 360 months. The interest rate, let's say, is 6.5% with the first payment date of the first of this year, just for this example, okay? The payment for a 715 loan amount at a 6.5% rate for principal and interest, not property tax or insurance, just principal and interest, is $4,519 a month, okay? What this program allows you to do is, have we all heard of paying points? I'm going to explain that. When you see paying points, or for a quick example, let's look at bankrate.com today. I priced this out for doing a 7-year. Let's take these off and just do 30-year fixed, okay? Look at the same, basically the same scenario today. 30-year fixed. You see, this is a 5-year ARM. Let's find a 30-year. 30-year fixed right here, okay? 5.625%. Now, we all know when the national average rate on 30 years is like 7% right now. We know that there has to be something, some caveats with that. So we come into the points. You see where it says points right here? This refers to paying a percentage of your loan amount up front to get that interest rate. This is saying 1.753% of your loan amount is what it will cost you today with this firm to get this interest rate. So we go 715 times 0.01, 753, $12,533 it will cost you up front on top of your lender fees for processing an underwriting loan, on top of your title fees for your lender's title policy that your buyer will have, on top of your escrow costs, on top of your appraisal, on top of all the normal closing costs. It's saying you'll have to pay $12,533 to get that rate. Someone may have one without points today listed. I don't. Here's one. Third Federal Credit Union is listing 0 points for this rate today. That's for a 5-year adjustable rate mortgage though, okay? So you see here what points mean. Points refer to paying an upfront cost to have a lower interest rate than the market rate. It's called discounting your rate. I'm paying discount fees to get a lower interest rate. Now, the way that the 2-1 buy down works is they're saying you can pay a portion of points to get a lower monthly payment for the first few years, but your actual interest rate is going to be the market rate. So it's a little cheaper when you do it this way. And the benefit is when you have a seller pay this up front, it may be less than what you would have to ask for, as you could see, to get a palatable 30-year rate. I mean, look at this. This is just an example. These are the cheapest online lenders in the nation, and I can match any of these guys. So just know that, or I can even beat them sometimes. But the cheapest 30-year rate you're seeing is 5.625 with a no-name lender that would be very scary to send your clients to for 1.753 points, okay? For my example here, I'm just giving an example of this. We'd have to price it out directly on the day that we do it. But in this scenario, you'd keep your 6.5% interest rate, that you get your market rate today. But the first year, you'd make a payment based on a 5% interest rate. So let's come down here. This is your payments 1 through 12, your first year. The balance, the interest rate, their actual rate is 6.5, but they're only paying a 5% interest rate when they make a monthly payment each month. That payment is $3,838 a month. It is $681 less than if they were to start off with their 6.5% 30-year fixed. Also, what is the actual payment though on a 6.5? It's $45.19. So What's happening? Where's that $681 going? Is that money going on top of the balance of what they owe every month? That's what's called a negative amortization law. When you're only paying, when your rate is 6.5, you're only paying payments on 5%, and the difference gets added on top of this loan balance every year or every month. So month 2, the loan balance would be $715,681. Month 3 would be $716,362. Month, you get where I'm going with that? It would be increasing what you owe. You're just deferring what you owe. That is scary. We never want to sell anybody on that ever again. That's how people get in a bad position and can't hold on to their homes. This loan basically is saying if you pay a buy down fee up front, which I'm just giving an example, 1.5% of the loan amount, if I pay that up front, or if I have a seller credit that up front, I then can make a monthly payment of $38.38 for the first year. I'm saving this amount every month, okay? And over the period of the buy down, which is 3 years, I'm going to save $13,687. But why this program is great is it's saying, hey, the first year when you're getting comfortable and used to owning a home, and maybe you have some extra expenses like furniture and, you know, even just fix-up costs. When we get our home inspection, we all know there's going to be stuff, even if you get everything fixed through the closing, there's going to be stuff that's going to come up later. You know, you can get a good idea of even the time frame it might take for the water heater to go out. When you get your home inspection, you go, oh, your realtor goes, hey, you know, you got about 2 years left on this, probably what the home inspector says. So you know it might be a cost you're going to have in these first 3 years. So you may want to have a lower payment to start off. But why this loan is so cool is that you're going to pay less upfront points than you will to get a lower starting rate, okay? If you were to buy down your interest rate and actually buy it down to an example that I gave over here, which give this example with the lowest lender in the nation on 30-year right now, you are going to pay, where's that example? You're going to pay the 1.846 points to start off with. Excuse me, that's the wrong one. You're going to pay a 1.753 points to start out with a 5.625. Or you can pay 1.5 points to start off with a 5% rate. Remember, your rate's 6.5, but you're starting off with a 5% rate. Then on year 2, second year, the second year, your rate's going to go to a 5.5%. You still have a 6.5% rate this whole time. But the second year, your monthly payment is going to be lower by $459. Okay? Then when you get to year 3, the loan will reset and it will go to your interest rate. Now, that's the 2-year and then 1, which is your buy down, 2-1 buy down. The amount of points is going to be different depending on credit score, depending on down payment. I'm using 1.5% example, but there are many variables to how this works, as you can see, based on credit score. The loan amount. Is the loan amount above or below the conforming loan limits? The down payment amount. If you're W-2 or self-employed, it's not going to make a difference. It's all about what your income ratios are and your credit and your down payment. But that's going to change on this, right? There's also an option to do a 3-1 buy down, where you could effectively have, let's say, a 6% rate here. Okay? It's going to change all the math down here now. Now on year 3, you have a 6% interest rate. So now your payments are still lower by about $250-ish a month, $254 a month. Okay? So that will allow you over here to see that now on year 3, my payment is $232 a month less than the actual payment. So my actual payment now is $42.86. But this gives the borrower time to ease into their payments and not negatively amortize their loan, where they're adding money onto what they owe, not reducing it. So it's a very safe loan program, and it's a way where you can get, like I said, you could have the seller paid. You could ask for a $10,000 closing cost credit, and instead of using that money to buy down your interest rate to have a lower rate for the next 5 or 7 or 30 years, which you're probably going to refinance anyways, you can start off instead with a lower monthly payment, and that will gradually go up. And you're going to pay.
Reed, so just to kind of summarize and simplify this, so it sounds like this is an option for people who want a lower payment for the next 2 years. The advantages are it's a little bit better than the rate buy down because you're spending a lot less upfront. The rate buy down on the other loan example was about 15 or 16,000, but this one's only about 10,000. Third, you're not having negative amortization. You're still paying down your principal. And then in 2 years, if rates go down, you can just refinance to whatever the rates are then.
Exactly. Yep. 100%.
Awesome.
Okay. And again, this is one of those deals where you really want to try to get, just to talk about it real quick. I've never been in a market that it's so important to get a seller credit towards closing costs. If you just train the buyer, I mean, and again, you guys know better than I do, Steven, Samira, Diana, Cindy, you know this very, very well. Banaz, you're going to get there. Karosh as well. That sellers right now, every deal is going to be different. You might have your seller, you're just not going to get a credit from them, and it's the perfect property, and it's still going like for above market. I'm still even seeing that. There's still enough cash in the system where you're getting that. But by and large, that has changed. You can get a credit. We can get some type of credits from the seller up front without having to increase our offer price, or at least we negotiated a little bit easier than we did 6 months ago, even easier than it was a month ago. I mean, the rates went up another 1% around the, just overall over the past 30 days, the market adjusted that way. So I think as sellers start to be more aware of this, and they are becoming more aware of it, and as some of the COVID money, the COVID savings depletes, it's gone, then I think that we're going to start seeing sellers have to be more realistic as this goes a little bit longer. Still have a big inventory problem. And that's going to lead me into my next part.
So real quick, Reed, before you go into the next part, just kind of breaking this down into, as real estate agents, how do we use this information to connect with a client, right? Because people they're emotional and they're a little bit less logical. And what I've found in my sales career is that even though I love the finances and I love going through these numbers, I have lost clients by going a little bit too much into the math because they just have a hard time following along with me unless it's visual, like what Reed's doing with us now. So how do you connect with a buyer and convert them to be your client? And you turn this into a question. Hey, what were you quoted when you got pre-approved? Or what has everybody been telling you about interest rates? They're going to say, well, I think they're 6.5 or 7. That's awesome. If I knew of a way to get you a 5% interest rate, would you be open to meeting about it? Now you're piquing their interest, and you're having something that no other realtor is talking about. And before you go into it's a 2-1 buy down, it's this, it's that, because Reed is the expert. Reed's the kind of person who has the in-depth knowledge to answer their nuanced questions. But you could use those questions. What if I could get you a loan with 5% interest rate? Would that change your decision-making process, or would you be open to meeting about it? And then from there, you try to get an appointment, book a buyer consultation with them, and introduce them to Reed. So as he's going through all this, be thinking about what information can I turn into questions that connects with the buyers?
Oh, no. This is exactly it. I mean, you have to have those points to get them to pique their interest because of just the environment that we're in right now. And I have quite a few that I'm gonna cover here in a minute. Ones that I've personally experienced in the past, call it 6 months, and just some of my objections to that. So yeah, I think if you can mention like a 5% rate, that's going to be something that's really going to excite them.
Diana, did you have a question for me?
Yeah, just really quick question, just to make sure I understand correctly. When there's the 2-1 buy down, isn't necessarily the first year is 2% less, the second year it's 1% less. It depends on how much of a discount they're going to get from that. It's going to depend on their credit score, DTIs, things like that. Is that correct?
Yeah, and the down payment, all that stuff that's required for the loan. And then,
Got
yes,
it.
credit tiers and things like that are going to affect the note rate, right? To start the actual rate itself that then everybody adds their margin onto. So it's a really good
Got it.
question.
Okay, so like a 1-0 is like gonna be like a less of, not necessarily 1% buy down, but it's gonna be less. A 2-1 buy down is gonna be a little bit more, and then I think you have on here like a 3-2-1 buy down. That's not gonna be necessarily a 3% discount. That's just gonna be like a more hefty of a discount, but not necessarily 3%, depending on the variables that you mentioned. Is that correct?
Exactly. These up here, this is a good question. When you hear 3-2-1 or 2-1, it's not saying you're going to save 1% of the rate the first year, 2% of the rate the second, and 3% of the rate the third, or 3% the first year, 2% the second, or 1% the third. It's saying this counts for the amount of years, right? So your 3-year, 2-year, 1 year, it's basically showing you like you're starting out with like a lower payment over this amount of time. That's all it's saying. So the rates themselves, focus on it on this end. They're not going to be huge spreads like that, although I wish that they were. They're going to be like a 0.5% difference, maybe 1% difference, maybe depending on the credit score. But this is actually meant to show you like the amount of years that the buy down is going to be in effect.
Got it. Okay, so it's going to be between 0.5% to 1.5%, and it's going to slowly reduce for the number of whatever, like 3, 2, or 1. It's going to slowly go back to normal.
You're going to start out with, remember, the lowest payment, right? With the lowest rate based on it. Then your next year, it's going to creep up. And then depending on if you do a 3-1, it's going to then creep up on the third year. And then on your fourth year, you're going to be finally paying the payment that is tied to your actual interest rate.
Got it. Okay, that makes sense.
The amount of spread, exactly, but the amount of spread between the rate you start with, right? It's not going to be tied directly to, is it exactly 1% or is it 1.5% or is it 0.5%? A lot of that's going to be based on the credit score.
Got it. So like in that period of time where it's slowly adjusting to be a higher and higher rate, how much it adjusts isn't set in stone from the beginning. It's going to be based on their credit score as time goes on.
It's going to be based on, it's going to begin with exactly how it will adjust. But how it begins is based on the credit score and the down payment.
So in other words, Reed, basically, if I come in and I've got 800 credit, 20% down, I'm probably getting the better rate schedule from the beginning. If I come in with 10% down, I've got some issues with my credit. Maybe instead of 5%, I'm going to get 5.5% on the first year, 6% on the second year. So it's going to change based on that. But you're going to know from the beginning, you're going to be locked in. It's not adjustable. It adjusts automatically.
Exactly. It's locked in though from the beginning, based on your credit profile, income, and down payment. Yep. Perfect.
Thank you.
Perfect. Absolutely. Do we have any other questions on this one?
I do have one quick question. Okay, so in the beginning, before everything, you said it didn't matter whether you were a independent contractor or a W-2 employee. All that mattered was your income, your credit, and all that, right? So that doesn't matter.
Yeah.
Okay.
Yeah. So the way that we qualify you for a mortgage, let's say you make $10,000 a month of income. Okay. If the monthly payment on the home you're buying is $4,000 a month, $4,000 divided into 10,000 is 40%. You have a 40% debt to income ratio. Okay. For loans like this, you can't be above, let's say, 50% debt to income ratio. Okay. So that's how we qualify you. That's what debt to income ratio means. We then take any other debt on your credit. So any auto loans, let's say you had a $500 auto loan and nothing else on your credit, not even credit cards. Now you have $4,500 a month of obligated debt. $4,500 divided into 10,000 is 45% debt to income ratio, right? So that's how we qualify you for these types of loans. Now, when you're self-employed or W-2, when you're self-employed and you get 1099s, you're able to then take your deductions at the end of the year, and then you have your adjusted gross income. Gross income is before tax income that you made. Adjusted gross income is after all of my deductions, because I'm 1099, on my auto, you know, and all my meals, all that stuff. How much did I make after that? That's your adjusted gross income. We take the adjusted gross income and we use the same math I just gave you to find out what is your debt to income ratio. So when you're W-2, it's just a bit easier because the employer's paying it and you're not able to take the same type of deductions you can when you're 1099. But we're basing the formula how we qualify you off debt to income ratio. So it's all about your write-off. So my point is, whether you qualify or not comes down to your credit, your debt to income ratio, and then how much down payment that you're putting. So whether it's self-employed or it's W-2, it's not going to make a difference because we're not basing the approval off that, right? Basing it off your income after your deductions. So yeah.
So in other words, it's available to both self-employed and both and W-2 borrowers. And then the self-employed, just like Reed said, like I'm self-employed, right? Let's say I make $100,000 a year, but I have a $20,000 car lease or office space lease or something like that. I have marketing costs. After I write all those stuff off, let's say I only make $50,000 a year, right? And then the next year, let's say I made $125,000, but after all my write-offs, I only made $75,000. And so now I've got the $50,000 plus the $75,000. I've got $125,000. They're going to average that over 2 years. So it's going to look like I only make about $62,000, which might qualify me for like a 1-bedroom condo or maybe like something in the Inland Empire for like $253,000.
One really cool thing too, if you've been self-employed for 5 years, then we can do a 1-year tax return. So we get your prior 2 years taxes, but we can base your income off your most recent year. So if you made, in that example, more money last year, then you've been self-employed for 5 years, we don't have to average your income over 2 years. We can average it over 1 year. So now we'd have $75,000 of income to use for last year. So as you grow your real estate business, you'll be able to, when you have a big year, you'll be able to use that full year's income, you know, if you've kept your credit good and you got some good money for down payment. So, but yeah, that was a great way to explain it, Stephen. Any other questions about the 2-1 buy down?
I got one. Kind of like with the conventionals and the VA and FHA, and they all have like minimum credit scores of 620 and stuff to come in. Does this also have a minimum as well?
Absolutely. So you want to be above a 640 credit score to do a temporary buy down loan.
Okay.
And your interest rate with that type of scenario starts to look very, it just gets hit a lot right now in this market, especially if you're going minimum down payment. So this was meant to be a good general place to start to explain how this program really works. And then we can get more intricate on a personal conversation, and I can show you guys exact pricing, or even on the next time we do this webinar. And I can talk more on specific examples. But yeah, there's a minimum credit score. These loans are tied to conventional loans, Fannie Mae, Freddie Mac loans. You can't do this on an FHA loan, which is the loan is insured by the Federal Housing Administration. It's a government loan. You can't do it on government loans. It doesn't generally work for any other type of loan other than a conventional mortgage. So the guidelines for the loan are going to be based on conventional guidelines with a few other caveats to that.
Perfect. Thank you.
Yep. Cool. So this is one good tool that we want to use. And then I did a PDF version of this also, which I'll send out to you guys after, just so you guys have this to look at more and to study more if you have more questions later. So just as a good overview.